All right, everyone, let's get right into it. This is your rapid-fire masterclass on capital gains. We are going to nail down a simple, four-step framework so you can tackle any problem the exam throws at you. Let's go.
So, picture this. You're in the exam, you flip the page, and you see a question where an asset has been sold. What's the first thing you do? You calculate the capital gain. That is exactly what we're going to master right here, right now. We're building a clear, logical path straight to the right answer.
Okay, step one, and honestly, this is the most critical question you have to ask yourself first. Is the thing that was sold even a capital asset according to the Act? Because if it's not, guess what? No capital gains tax. The problem stops there. But if you get this wrong, your whole answer is just gone.
Now, have a look at the definition from section 214. It says a capital asset is property of any kind. I mean, just think about how incredibly broad that is. Your default setting in an exam should be that pretty much everything is a capital asset. Land, buildings, shares, patents, it's all covered. The real skill, where you score the marks, is knowing what's been specifically excluded. And here they are, the crucial exclusions. These are your classic exam traps. Stock and trade? Nope, that's business income. Rural agricultural land? Out. Specific gold bonds? Out. But the one that trips up so many students, the one you absolutely need to circle in your notes, is personal effects. Let's zoom in on that one. And I'm not exaggerating here. Listen carefully, because this is exactly where I see students lose easy marks time and time again. Understanding the exception to the personal effects rule, well, it's absolutely vital. And this table just lays it out perfectly. Look, your personal car, your furniture at home, those are personal effects, so they are not capital assets. But, and this is a big but, the law specifically says certain items are not personal effects, even if you use them personally. We're talking jewelry, paintings, sculptures, things like that. These are capital assets.
Okay, let's dive in with the absolute bedrock concept. Seriously, if you don't know what a transfer is, you can't even start the problem. Now, Section 247 gives an inclusive definition. That means the list isn't exhaustive, but for your exam, the specific items on that list are what you absolutely must memorize. These are the main types of transactions you're going to see in your exams. You need to be able to identify them instantly. Sale, exchange, extinguishment, compulsory acquisition, all of these count. So the crucial point is to remember this broad definition. Why does this matter in exams? Simple. The very first step in any capital gains question is to identify if a transfer has even occurred. You get this wrong and the entire answer is incorrect. Pay close attention now. This is a scoring area. Do not skip it. Knowing what is not a transfer is just as important as knowing what is. This is your high-yield list. These are the exemptions that are frequently tested, so make sure they're right at your fingertips. Gifts, HUF partitions, reverse mortgages. Know them cold. Okay, quick test. Let's see if you're with me. A father gifts gold to his son. Is that a transfer for capital gains? Think about the rule for gifts. Correct. It's not a transfer, so no capital gains tax arises for the father. The tax implications will only kick in when the son eventually sells that gold. Now let's put a special focus on the reverse mortgage scheme because it has two separate benefits you absolutely need to know for the exam. And here it is, the dual exemption. First, the mortgage itself is not a transfer, so no capital gains. Second, the money the senior citizen receives is exempt from tax. Both are crucial points. So the big takeaway here is to know these exceptions cold. Why it matters in exams? If you can identify a Section 47 transaction, you can immediately state that no capital gains tax is applicable. That saves you a ton of calculation time and earns you full marks for that part of the question. To summarize everything, if you just remember these 3 golden rules, you'll be able to handle most of the tricky questions on this topic. It's all about the date of transfer, the timing for stock conversion, and knowing that Section 47 exemption list.
Great, so you've confirmed it's a taxable capital asset. Now, on to step 2. We have to classify it. Is it short-term or is it long-term? The answer comes down to one thing and one thing only, the period of holding. And this single decision will dictate the entire rest of your calculation.
I really want to stress this point. Don't just blindly memorize the time periods. Understand the logic. Once you can confidently classify an asset as short-term or long-term, everything else just falls into place. Whether you get indexation, which tax rate you use, it all becomes automatic. This concept is the key that unlocks the whole chapter.
The rule itself seems pretty simple, right? But its application is where all the traps are hidden. The key words are took place. Listen carefully, this is where most students make mistakes. It is the date of transfer, not the date of the agreement, that determines the year of taxability. The exam question will almost always give you both dates just to confuse you. In short, you've got to focus on the date the asset actually changes hands. Why this matters in exams is because they're testing you. They'll give you a bunch of dates to throw you off. Picking the right one is absolutely key to calculating the tax for the correct assessment year.
Okay, so for any transfers that happened before July 23rd, 2024, look at this table. You've got 3 tiers. Top tier, listed securities, mutual funds. The cutoff is 12 months. Middle tier, unlisted shares and property. It's 24 months. And the bottom tier, which is the catch-all for everything else, is 36 months. You need to know these 3 buckets cold: 12, 24, 36. Now, for transfers happening on or after July 23rd, 2024, things got a lot simpler. Take a look. The 12-month rule for listed securities, that's still there. But see what's missing? The 36-month category is gone. It's been eliminated. Now everything else just falls into one single 24-month bucket. This is a huge simplification and a super important update for your exam.
So to recap step 2, check the date of transfer, check the asset, and then classify it, short-term or long-term. Think of this as a critical fork in the road. One path, the long-term path, gives you that amazing benefit of indexation. The other path, short-term, doesn't. The tax rates are totally different. If you take the wrong turn here, every single number that comes after in your answer will be wrong, period.
All right, moving on to step 3, actually computing the gain. We've identified the asset, we've classified it, now it's time for the math. And for this, you must follow a very strict pro forma if you want to get full marks for your presentation. And please, I'm telling you now, do not try to get creative here. The examiner is looking for this specific structure. Let's take a look.
And here it is. This table right here should be your best friend in the exam hall. Whether it's a short-term or a long-term gain, the basic structure is the same. You start with how much you sold it for, and then you just start deducting all your costs. Let's break those down.
It's a really logical flow. Number 1, what did you get for it? That's your full value of consideration. Number 2, what did it cost you to sell it? You subtract any brokerage or legal fees. Number 3, what did you originally pay for it? Subtract your cost of acquisition. And number 4, did you spend any money to improve it over the years? Subtract the cost of improvement. It's really just sale price minus all your costs.
Section 50C. This is a classic. The moment you see a question involving the sale of land or a building, your alarm bells for Section 50C should be ringing. So pay very close attention here.
Now you might think, hey, I sold a property for a certain price, so that's what I report. Right? Simple enough. But is that what the Income Tax Act says? Well, not always. This is exactly where the department can step in and challenge your number.
So the law makes you do a little comparison. On one hand, you've got the actual price you sold it for. And on the other, you have something called the stamp duty value, or SDV. Think of the SDV as the government's official minimum price tag on that property. And one of these two values is going to be what you use for your tax calculation.
Okay, listen carefully because this is where most students make mistakes. It is the 110% rule. It's simple. You take the stamp duty value and you compare it to your sale price. The big question is this: is the SDV more than 110% of your actual sale consideration? If the answer is yes, you have no choice. The stamp duty value becomes your full value for calculating capital gains. If the answer is no, you're safe. You can just use your actual sale price. Getting this one rule wrong can make your entire answer collapse.
Now, there's a really critical exception here. Sometimes you can use the stamp duty value from the date you agreed to the sale, not the final transfer date. This is a lifesaver if property values are shooting up. But, and this is a big but, it only works if you meet 3 conditions. 1, the dates have to be different. 2, you got at least some of the money on or before the agreement date. And 3, crucially, that money came through a proper banking channel, no cash. Remember this, a multi-step property sale question will always have a trick related to stamp duty value.
Get this concept right, every related question becomes easy. It's a foundational block. Nail this, and the tough questions start to look a lot simpler. So let's jump straight to an exam cheat sheet.
Let's break this down. Simple rules. For self-generated goodwill of a business, or any other intangible you created yourself, what's the cost? It's nil. 0. Don't go inventing a number. Next, In a merger, the cost of your new shares is just the cost of your old shares. It carries over, simple as that. And finally, in a demerger, the original cost gets split between the old and the new shares based on a specific formula.
So, what's the recap? For self-generated assets, the cost is zero. For corporate stuff like mergers and demergers, the cost isn't lost, it just gets carried over or split up. Why does this matter? Because examiners absolutely love to test these little exceptions to see if you're paying attention. These are easy marks if you just remember the rules.
Now, here's the absolute game changer for long-term assets. You don't just subtract the original price you paid. For long-term capital gains, you get to subtract the indexed cost of acquisition. This is a huge benefit. The law literally lets you inflate your original cost to account for inflation, which can massively reduce your taxable gain. But, again remember, this benefit is mostly gone for transfers from July 2024 onwards, which makes knowing that date so critical.
Okay, the takeaway for step 3 is simple. Follow that pro forma. Follow it exactly. Why does it matter? Because examiners literally award marks for each correct line item. And for long-term gains, correctly calculating and showing your work for the indexation formula is how you prove you've mastered this. Slump sale, section 50B. This is a scoring area. Do not skip it. The entire game here is mastering one single calculation: net worth.
So first, what even is a slump sale? Just think of it like this. You're selling an entire business unit, like a whole division, in one go for one single price. The key phrases are lump sum and without values being assigned to individual assets. You're not selling a machine here and a building there, you're selling the whole shebang.
Now, in a slump sale, your cost of acquisition is the net worth of that business unit. The calculation has rules. For depreciable assets, you take the written down value, the WDV. For those special 35AD assets, it's nil. For everything else, it's the book value. But, and here is the most critical rule, the biggest trap, you must always ignore any change in value that comes from a revaluation of assets.
So to get the net worth, you're going to add up the tax values of all the assets, the land, the machinery, the debtors, and then you subtract the outside liabilities. But what's the most important part? You might see a revaluation reserve on the balance sheet. What do you do with it? You ignore it. It's a trap. For this calculation, it doesn't exist. Any artificial pump-up of an asset's value is completely thrown out. This is the exact trap you're going to see. Okay, let's recap this one more time. Slump sale, your cost is net worth. You use WDV for depreciable assets, book values for others, and you absolutely always ignore revaluation. Why does this matter? Because this is a guaranteed 5-mark calculation inside any complex capital gains problem. Master this formula.
We're almost there. We are on the home stretch. You've identified, you've classified, and you've computed the gain. The final step, step 4, is to apply the right tax rate to that number you just calculated. And here's the thing, it's not always your normal tax slab. Capital gains often play by their own special set of rules. For short-term gains, it's pretty straightforward. There are basically 2 lanes. Lane 1 is for listed equity shares covered by Section 111A. That gets a special flat tax rate. And notice the rate change from 15% to 20% from July 2024. Lane 2 is for everything else. Any other short-term gain just gets added to your total income and is taxed at your regular slab rates. That's it. Now, long-term. This is where you need to be really sharp. Section 112A for listed shares has its own special rate, but the catch is you don't get the indexation benefit. Then you have Section 112 for other assets. The default there is 20% with indexation. But, and this is a classic exam point, for certain assets like unlisted securities, the law gives you a choice. You can pay 20% with indexation, or you can choose to pay a lower 10% rate without indexation. Your job in the exam is to calculate the tax both ways and pick the one that's lower.
And finally, some absolutely vital rules that they love to test in case studies. First, you cannot claim your Chapter VIA deductions, like 80C, against these special rate capital gains. Second, if you're a resident individual, you can use your leftover basic exemption limit against these gains. That's a huge point. And third, the Section 87A rebate is not available against long-term gains from listed shares under 112A. These are the little details that separate a good answer from a great one. So, let's recap this final step. You have to identify the correct special section, 111A, 112, or 112A, and apply its specific rate. Look, calculating the gain correctly is only half the job. If you then apply the wrong tax rate, you're just throwing marks away.
And that's it. That is your clear 4-step framework to solve any capital gains problem.
Number 1, identify if it's a capital asset. Number 2, classify it as short-term or long-term. Number 3, compute the gain using the proper format. And number 4, apply the correct special tax rate. You have the structure, you have the knowledge, stick to this process, and you will absolutely be in control. Now go ace that exam.